they had to file bankruptcy, a bank will lend to that person.
Why you start with a building for house hacking?
Your rent went up $300. No, maybe we just have to save more. Okay, great. How much have you saved in the last year? Nothing.
Why is financing of a mortgage is so scary to the consumer?
It's a great question. I think that for most people, the hesitation is in possible rejection, to be honest. It's more like that fear of the unknown. Anybody can qualify for a mortgage. It's just setting up the right expectations, building a plan, and then working towards that plan. Not everyone is ready today.
100%.
Right? And so you have to understand, what does your position look like now? And what is your goal? And now let's fill in the blank. How do we get there?
That's a good point. So it looks like everybody have a desire of home ownership in some form, but not everybody is ready yet or at the moment they want to.
Right.
It is very large and broad.
Mm-hmm.
Let's really dissect it and say what are the five. Let's even get to one, the most difficult part for somebody to be qualified.
So if we were to narrow it down to one, I would say the first thing is going to be credit. Okay, so credit has to be established. Banks lend money based on risk, right? And in order for them to identify a good applicant, they have to see how that applicant uses their credit. So ideally, there's some credit established, there's some credit cards opened in their name, they're using them regularly, responsibly.
So a history, pretty much.
A history.
A track record.
Yes. And a good track record, right? Now, understandably, life happens, and sometimes that track record isn't so great, right? It happens. That doesn't mean that you'll never be able to get a home. It just means you have to understand what the guidelines look like.
Exactly.
And
Should
then,
anybody be scared of applying if they have a bad check on their record?
not at all. I think the best thing is to understand, how does your credit history impact your buying power? And again, prepare that plan, because you can get there. Let's be a little more specific, right? So let's say, for example, someone had a hardship that required them to file bankruptcy. They lost their job. Maybe they were dealing with illness. We don't know. And if they had to file bankruptcy, a bank will lend to that person after a certain period of time has passed. So they just want to see that things have changed, things have recovered. It's been a few years now since that bankruptcy, and you've established some good trade lines again, and you have a good payment history in the last couple of years.
That's a very specific example. And I think a lot of, especially business owners, been in that situation and post-COVID, but also a lot of average consumers too had filed for bankruptcy. What is the average time somebody could consider buying a home or a property after bankruptcy?
So there's a few different waiting periods depending on the program, but I would say that if it's been 2 to 3 years since that bankruptcy, then you may be fine. But again, we'd have to look at the full picture to better understand.
So it's still everybody's specific situation.
Yes.
Now, what would be initial steps for someone to get ready to shop for a home?
So the first step in this process is always going to be to have a conversation with a professional. And that would be a mortgage professional that can help them understand what their buying power looks like and helping them prepare that plan. So that's always step one. Just have a conversation to discuss your goals and understand what your credit profile looks like and how that compares to guidelines.
So simply saying, don't think that you're alone in this. Find a professional that will support and guide you through the process.
Yes.
Who should be first considered then? A real estate agent or a lender, loan originator?
I love that question. I think that traditionally, most people think to go to the realtor, right? Because you find the house, right?
That's what I did first.
That's just usually the commonality there. And then you, as a real estate professional, you're a resource. So you connect people with professionals as myself that offer financing.
Pretty
right?
much.
So I think that a person can go either direction. They can get information on the process of buying from yourself, and then they can get specific details on the financing side from me, from a mortgage professional. So they can start either way, either place, but I would be able to help guide them on the guidelines and building their financial plan.
Now, I did exactly like you said back in 2019 when finally me and my wife made a choice that we will proceed with the search and we have a goal to purchase our first home. We went to a real estate agent, right? And that's how things started. Always the banks and the loans and I would say fancy words or the statuses like loan originator, lender always sound so far off. And real estate, I guess, agents and realtors feel just a little bit more approachable. But things, in my opinion, change, especially these days and after a few years, things are changing. Hence social media and also the diversity of people in the industry being able to bring the information in other forms. Now, considering we still touching the aspect of the first time home buyers, once let's say they decide they want to really, really move on, they want to see homes. Now, do they need pre-qualification or pre-approval? A lot of people seems like they confuse these two.
There's a big difference between a pre-qualification and a pre-approval. And if someone is serious about purchasing, then they really want a pre-approval because a seller is going to take that buyer's offer more seriously if they have a pre-approval letter.
Okay, makes
because
sense.
they've gone through extra steps to get that. So the primary difference between a pre-qualification and a pre-approval is that the pre-qualification doesn't verify the information provided. Someone can call in a bank, talk about their credit, their income, and be what we say pre-qualified, right? Without that lender actually collecting their documents. And let's go back to the example of somebody self-employed. Someone who's self-employed has to provide federal tax returns, and a lender will typically average their income over the last couple of years. Without seeing those documents, we have no idea what the effective income is to qualify them. And so if they verbally say, I make $10,000 a month, but then their taxes show write-offs and they make $6,000 a month, that really changes their buying power. And that's why the pre-approval process is important because it's more detailed, there's more paperwork involved, and there's further analysis that's completed. And then this gives the seller confidence that that buyer is able to purchase their home.
Not only interested,
Not
but
just
actually being
interested.
able. That's what it makes
Yes.
a big difference. All right. So being pre-qualified, it is more of a quick 5-question answer and a promise that you could be considered
Yes.
for that, but definitely you don't have anything yet in hands to go shop around.
Correct.
So sounds like pre-approval really bases on what people get to keep after taxes. So that's their income considered towards the buying power,
Yes.
right? Now, there's a term, the abbreviation is DTI, and when I mention it, everybody's getting scared. It's something out of the law or whatnot, but can you disclose for us and open what is
DTI. So DTI, debt to income ratio, it's a ratio that the bank uses to, again, calculate risk to determine if an applicant is able to borrow money from the bank. And so what they do is that they look at all the debts a person has on their credit, which is your credit cards, minimum payment, any car loans, student loans, plus this new mortgage you're applying for. And they compare that, they divide that by the income that we use to qualify. And so there are different thresholds for this number depending on the program. But usually the bank is looking for your debts, again, what's on your credit report plus the new mortgage, to be less than 50% of the income. And that's a very broad statement, so it doesn't apply to everyone.
right?
But that's generally how the bank looks at calculating risk for a new applicant.
I see. So, and why is that? Why it cannot go over the 50%?
It would be
Too risky.
so it's all about reducing risk.
Basically, if you just use 100% for your mortgage, you need money to live off.
Yes, you have to eat.
But most likely, people will prioritize the immediate issues like the food, the transportation, maybe some medical bills.
Survival,
Yeah,
right?
survival. And then the home will be left.
So if we could do an example, let's say let's go back to that person who's self-employed, and let's say the person that's self-employed on paper they show $6,000 when we
Right.
calculate their income on their taxes. If that self-employed person has debts that total about $500 a month, right? So we take $6,000 of income, 50% of that is $3,000, but they already have $500 towards car payments. That means that they could have a $2,500 mortgage. And that would
Assuming
be
if they don't have
no other debts,
no other
right?
debts.
Then the bank would say that's about 50% of your income. We're okay to lend a mortgage. That includes the loan, the property taxes, insurance, for the mortgage insurance if it requires it. If that's within 2,500, then we will approve your loan. Okay, so that's just one example on how they calculate risk.
And interesting, but $500 a car, that's about average baseline nowadays. How do you look at, we have some clients sometimes and they have the pre-approval and they think everything is settled and they submitted an offer and let's just assume no obstacles, they're moving towards closing. Is it really like done? Is the ball in the court? That's it? They won? Can they still be declined by the closing or on the closing date?
So your pre-approval is based on a financial snapshot of your credit file. So it's approved on how your credit looks right now and how your income looks right now. And then when you get a contract, you go through the process of underwriting and they're re-verifying the information. If something changes from the time you applied to the time you close, then yes, you can get denied because your credit profile has changed. So let's do an example. Let's say that same person that had the $500 car payment, let's say their car needed to go. It got totaled, They need a new vehicle. And so they go and they apply for a new car because their new home is 10 miles from their job.
Right.
So if they apply for this new car before they close on their mortgage, there's a new debt. And that would then kick out that debt to income ratio we discussed of 50%, right? And now they no longer can get an approval.
What if the car they buy stays at the same cost or less? Well, it's also at 500. Will it still kick it out?
So if the first car payment is settled by the insurance company, and if it's settled and then they open up the new debt, we're good. But if they at the time have two car loans,
Right.
then that would be a reason for a denial.
And we're not going to go right now into how insurance treats us
Oh.
nowadays and the cost of insurance and everything and how claims being denied left and right. So, but also the processes could be dragged down. So what you're saying, basically, it might be the same cost, but what I understand, if within this span of closing, which usually happens between 30, 45 days, somebody might end up having two car loans. Even maybe it's getting covered by insurance, but at the time it's still there. They have to pay, and it's like $7,000 there and a new 15,000 loan there. So basically, it just kicks them off their budget. How could be that salvaged, if ever?
So the best thing, so this is real life examples, and this happens, right? The best thing for anyone that is going through the process of getting a mortgage is to communicate with their bank if something is changing. So whether that means that they need to purchase a new vehicle, maybe their employment situation is changing. They got a great job offer. Can they accept it now? Or maybe it means that there's movement of their assets. They have to pay a car in cash.
Right.
So whatever the situation is that may be affecting your credit or your income that's being used to qualify, or the assets that are being used to qualify, have a conversation with the bank to determine what the workaround is, what the timeline looks like, and how can we keep this together in an approvable manner so that you can close successfully and not delay things.
And just to wrap it up on the approval thing, is there a time frame that this is valid, or how long can I keep a pre-approval? How long can I use it?
So a pre-approval is usually good for about 3 to 4 months. So the credit report that we use for a pre-approval is good for 120 days. So if you're shopping and you're at 90 days into that 120-day time frame, your pre-approval is going to expire within 30 days more. So it depends on the timing of that contract. So that's why I say 3 to 4 months on that pre-approval. If you get under contract and your credit is expiring very soon, you want to have it repulled right away so that you don't have any issues should the closing be delayed or past that 120-day window. So always keep in mind your pre-approval does have an expiration of 3 to 4 months.
Interesting. Now I go back to my experience. It took us a couple of months first to find and then probably a month and a half to close. I think my credit score was pulled 3 times and I had 3 times pre-approval with the same lender. Why would this happen?
They would have to tell you.
And this was 6 years ago now,
Yeah.
so I don't know. They probably were using an old computer for that.
It shouldn't have to have had repull. The only instances that we have to repull credit during an application is if maybe there was new debt that was opened and we can't do a credit supplement, so we have to do a repull.
Yes.
Otherwise, it should be valid. But it's also safe to say that every lender is a little bit different. And so maybe that's a question to ask the lender.
And every client. Maybe I wasn't the easiest client. Who knows? I'm not going to go that back now. But interesting. Yeah. So we need a good agent. We need a good loan originator. Communication is key. But still, nowadays, buyers have real hard time buying. They might be pre-approved. They might be well qualified. So they're able, how we call it. They're also willing. They have the desire. But it doesn't happen. What do you think is what's preventing them from that in this market today?
In today's market, inventory is extremely limited. And I think that especially for our first-time buyers, they're up against so many other first-time buyers shopping in the same price points in certain areas that it becomes very difficult to win over a bid. And sometimes that means that you're going over the asking price. Or maybe you are putting larger down payments to win so your offer appears stronger. Not everyone wants to deal with being in a bidding war, one.
Right.
Yes, it's very emotional. And in other instances, maybe they're already shopping at their top price point and they can't go over asking price because the numbers don't make sense for them from a monthly payment standpoint, right? So I think inventory is one of the struggles that buyers are having issues with today. And sometimes that means being open to different property types or considering different locations. But that might not always be feasible.
Being flexible with the search.
Being flexible with the search is really ideal. And I go back to the property types. I have, to give you an example, I had a woman that came to me. She wanted to start investing. And so we were talking about house hacking, which is buying a building where you have some tenants that are helping pay your mortgage. But based on her credit profile at the time, she couldn't find a building in her price point. So we switched gears and we went and focused on a condo. And she found the condo within budget and closed successfully. A year later, she went back to revisit the pre-approval options, and at that point, she was able to get her building. So
interesting.
So we have to be flexible with it. If you're a long-term vehicle, real estate, and so being flexible with the goal and finding alternative solutions to get to that long-term goal is important.
I see. Now, I'd like to know maybe a little bit more in helping somebody who's in the same situation, because there's a big difference between a condo and a building, which could have 2, 3, 4 units, right? Now, what changed in her situation within only a year, which is very quick for real estate? Like you said, it's a long-term vehicle. You got to plan it ahead for years for this to actually start paying off significantly. But we speak in 12 months. Did her situation improve that much? Was it income? What was it?
Yes, in her case, it was income. So she had a new position that allowed her to qualify for the higher price point that she needed. And so that helped. And inventory, maybe at the time that I can't remember the details of what location she was looking in, but the numbers didn't make sense for the building. So a year later, the inventory changed, or maybe she was looking in a different area.
I see.
But the income definitely was a big change for her. And then there was inventory that made sense. So if ever anyone is interested in house hacking, We always want to start with the building, but if the building doesn't work first, the condo is another alternative to start, because you can move your condo space, your living space is the same, it's comparable to living in a unit in a building, right? So then you can start with your condo 3% down, and then when you could buy the building with 3.5 to 5% down.
Okay. So you get to leverage your financing power, your buying power towards a bigger asset.
Yes.
Okay. Perhaps track record also improved, like the paying for a condo, right? Qualify for real estate as well.
Yes.
Better. Yeah. Now, you kind of know why you start with a building for house hacking, and how actually a lender looks financing a building easier than a 4,000 square foot single family home.
So the minimum down payment for a purchase is usually 3% for a first time buyer. And if we're looking at a building, two different loan types. So we're looking at 3.5 to 5% down on a building. Those are the minimum down. 3% will be single family or condo. So reason why house hacking makes sense with the building is because from a lending perspective, we're using rental income to qualify. So the rental income is increasing the buying power, because now we're having the buyer's income, whatever that salary or self-employment income may be,
Right.
plus the income produced by the building.
So we're assuming we're going to rent those units.
Yes.
Okay.
The bank's looking at that extra income potential. And then you're able to purchase that building with little money down. So that's another benefit. You can do a 3.5 to 5% down payment on that building, because it's going to be your primary residence. If you buy the single family home first with your 3% down, and then you want to buy a multi-unit, well, it doesn't make sense. You're going to get up to 4,000 square feet to go live in
Right.
a thousand square foot unit, right? So that's going to now be an investment. And when you're buying an investment property, your down payment is 25%.
Okay.
So we went from putting only 3.5, 5% down to 25% down. So it's a huge difference on how much capital is required up front.
So it's more applicable for first-time buyers, who especially maybe moves from renting,
right?
now also just switches to the almost same size, maybe
Same size.
same style
Yep.
of living, but only assumes a loan and becomes a landlord.
Right.
Okay. And that's also an interesting occupation.
Yeah.
Yeah. That's a big topic on its own.
You got to know your landlord
Yeah.
rules, guides, yes.
For sure.
Yeah.
Okay. So hacking into the real estate, pretty much everyone who could be approved for a mortgage could use this strategy, right? And start building their real estate portfolio.
Yes.
Okay.
Absolutely.
Now, I know you touched on moving from a single family home and applying for a mortgage for a building. Now you have to consider it as an investment. But can you reverse the example? I know it's a little bit different math when you move from your place in the building. Let's say you live at the third floor and you rent it too. Now you're moving into a home. How does this works?
So whenever you move out from that building that was your primary residence, and now you want to buy your single family home for more space, your down payment requirement for the occupancy. So if you're going to purchase a 1-unit single family, your down payment as a repeat buyer is 5%. That's your minimum. So that's when we say house hack, start with the building, is because we're trying to protect your cash.
So in this case, even buying a single family, we're still pretty much hacking the system. I mean, using to our advantage.
You are, because you're starting, because the goal is to start with buying with the smallest amount of down payment each way, as far as you can. And then you're using each property, renting it out to help you buy the next one.
Okay. So move from building into a new home, new place, we're upsizing, maybe the family grows, we fully renting the building. Is there anything else to help this strategy, or at that point every other property would be just considered fully investment property?
So let's go through the whole story. So let's say we start with a condo, because that's what we can afford right now. We start with a condo, we do 3% down. The next property is a building. We can do 5% down on the building. 3.5 or 5%.
Okay.
We have the condo. Now we're living in this building, maybe we're living rent free. If you have four doors, right? If you have a 4 flat or
Right.
even a 3 flat with that other condo, you have 4 doors, you're probably living rent free. So now you save up and you want to buy your single family. So 5% down is the minimum, you buy your single family. Everything else is paying for itself, positively cash flowing. If you decide that you want to buy another piece of property and you can rent that single family home and it can pay for itself or give you some positive cash flow, then you can buy your next single family home and do 5% down. Or maybe at this point you've already made so much from your investments, you're putting a larger
Right.
down payment, right?
Right.
So you don't necessarily have to focus on the smallest down payment at that point, but you can continue to
You
buy.
can still maximize the usage of whatever buying power you have.
Yes.
And I like your example. You still kind of through without selling any of the properties yet.
Right.
Hypothetically, I own now a condo. Thank you, Michelle. I own a building and I own a single family. So I can buy another single family as long all of the rents cover every expense and I still can use 5%.
Yes.
What type of loan would that be?
A conventional loan.
Okay. Assuming still qualified for, right?
Assuming you're
Because
still qualified.
I'm assuming all this debt and
Yeah.
I don't know. We talked about ownership and expenses and maintenance and you
Right.
know broke down and you have to replace it full cost right away.
Right. It's
So
got to
that's-
make sense.
Yeah, it's gotta make sense.
Yeah, because the example is that you sell that single family home
Right.
and you take your equity there and you put it into the next one, right? So there's various ways to go about it, but it's definitely, it makes the most sense to start buying as many units as you can with little down to get into it. And then once you get that building, you know, you have other options now because you have additional cash flow.
Now I'm not sure if I just heard a rumor or was this TikTok. Nowadays they're the advisors, everybody.
Yes.
But if I want to get another single family home with 5%, should it be, same state or different state? What if I just want to move from west suburb back to north suburb or actually get back into the city? Is there limits on where can I apply this?
It just has to make sense. So if you wanted to buy another single family home to occupy, you want to move out of your house
Right.
and change. As long as it makes sense for work, you can be in the same, you can purchase all in the same, that's not an issue.
Okay. I guess where I'm trying to head with this question is there now a house hacking strategy continuing and getting property in actually different states, like, with a vacation home or like in...
Yes. So if you buy a vacation home in a different state, you can use a conventional loan to do that. And the minimum down is 10%.
Okay. Well, we're still not at 20. I like that.
Yeah. That makes sense because I'll be honest. I mean, you're going to have PMI, private mortgage insurance.
Yeah.
And at this time, there's not a big appetite for second homes. So lenders are charging more points. So if you're going to have to pay the extra points, sometimes it just makes more sense to put more money down. So the numbers have to make sense. But technically, it's 10% down. So you can absolutely buy another property in another state, 10% down. Assume you qualify now with that mortgage because we're not using rental income if it's a second home. So now you have to qualify with your first home mortgage plus a second home mortgage and any debt that you have in your credit.
Right.
So it's increasing risk to the bank.
Unless we buy that property to rent it out, but then it becomes an investment and...
20% down, yeah.
But to qualify.
Yeah, yep.
As long as you have the money because
Right.
the income.
Right.
Okay. Now, you just dropped 3 letters again, and I'm getting scared. It's not what you think, but the PMI, my God, what is?
PMI. So private mortgage insurance is a way for lenders to reduce risk. Remember, lenders are looking at ways to reduce the risk. So if you're getting a conventional loan and your down payment is less than 20% down, the bank will require that you purchase insurance, and it's private mortgage insurance or referred to as PMI. And this insurance is in place until you have at least 20% equity, and then it can be canceled. The cost, however, is not that expensive. Sometimes people do worry that it's dollars a month. It's a percentage based on the loan size, so it could be less than $100 a month.
About the condo, right?
Oh, yeah. And it depends on the loan size. So usually when someone goes through the process of getting a pre-approval, we go through these numbers, we compare what it looks like with 3% down, 5% down, 10% down, however much cash they have that they're able and willing to spend. We compare the different down payments, the different costs for the PMI, so that they can then make an informed decision on how much they want to spend. Because people think, oh gosh, I have to save 20% down,
I know.
or I'm going to pay insurance. But if the insurance is $40 a month, you probably would be okay buying today instead of trying to save up for a few years.
Yeah.
Yeah, for sure.
And then every year you need to save more, because every year what happens with real estate, it just keeps on going up.
Yeah. And rent also continues to go up.
Exactly. So if I had a conversation with one of my prospects last week, I'm like, well, if our cost of living goes up and cost of real estate goes up, let's say at the same rate, 4% a year, like when time, especially since COVID, your salary went up at least the same amount. It's like, oh, I actually changed job and I had to take a pay cut. I'm like, okay, detail, thank you. So now, like, if you're staying at the same job at the same pay for the next 2-3 years, your expenses keep on growing. Can you even collect for the down payment? Have you seen a trend like that?
Yeah, so I had a similar conversation with someone, and not at their income over the last year to determine how much have you saved. So, pre-approved last year, they didn't find anything they liked because they want a single family instead of a condo. A year later, we revisit, and the same conversation. Are you open, flexible to maybe considering that condo now? Your rent went up $300. No, maybe we just have to save more. Okay, great. How much have you saved in the last year? Nothing.
Maybe they tried, but then life happened. It drained everything they had, and they opened a credit card for it. And now it's like they ain't even back at zero. They just not even qualified at all.
Right. Yeah, it's always about saving the extra money. It really isn't, because if we do the math, 20% down on a $300,000 purchase is $60,000, right?
Right.
Your average income is 80 grand a year, and someone is paying, it's a month in rent, and they have student loans and a car. It's going to take a very long time to save $60,000.
Assuming nothing else happens in life.
Yeah. And all that time, they're paying $24,000 a year in rent. So they're going to pay that $60,000 to their landlord over 3 years, but it would take so much longer, and they could really buy with potentially $3,000 if we can get them a first-time buyer program, and a lot easier to save up. So having a conversation about the real numbers and not just an idea of, I can't do it, those blocks, we limit ourselves, right? We put these ideas in our minds, we set these boundaries, but really having a conversation is where everything starts. Running real numbers makes the most sense so that you can make a decision thereafter. And yes, to your point, a lot of the term sounds intimidating, but once we have a conversation, most clients feel extremely comfortable and confident to proceed.
Okay, so house hacking, they're 5% loans, assumingly, not that big, the private mortgage insurance. Who's to find that insurance?
The lender does it.
Okay.
Yeah, for the loan.
All right. What, then the consumer has any control over it or any say?
Mm-mm.
Not really.
No. We shop from, only maybe a dozen PMI companies that lenders use. So we're with those vendors that we normally use. This is an insurance policy that's required for their loan, so we're computing that payment and advising them what the payment is inclusive of that insurance. But the homeowner's insurance, which they also need for this purchase, they will shop for. So that they'll have, to choose an agency.
Okay. Now, can I get rid of that PMI? Can I get rid of it?
Yes. So mortgage insurance can be removed once there's at least 20% equity in the property. And the normal process is that someone would have to call into their loan servicer to inquire and then go through the steps that are necessary to then evaluate and remove that.
Now, as we're landing the plane, let's get from top down, somebody who's in the market today. It's competitive. There are multiple offers. What would be your piece of advice? How to win your purchase?
My advice for anyone that's buying today in this competitive market is to work with the right team. as a mortgage professional, yes, I know guidelines and yes, I qualify my clients, but I also talk to the seller side and I know what information they want that's going to help them feel comfortable so that they can know confidently that we're going to close successfully. So being with a local company that's going to have a good reputation and is willing to have these conversations with the seller side is going to help. So it's not you're going to offer the contract and the pre-approval letter, and then I'm going to call and I'm going to talk up our buyer as well,
I see.
right? So outside of having the right team, what else is important is understanding the numbers. So being flexible, and that if you are going to go in over asking price, that payment is still comfortable for you. We've ran those numbers. We're having that conversation
Right.
before you're signing
We
that
already
contract.
did the math before that,
Yes.
so we come prepared.
Yes. So it's not just about, I want to offer them exactly what they asked for, not a dollar more. But if extra affects your payment by $30 and you're going to get the home that you love in the neighborhood that you love,
Right.
is it worth the $30?
I like
know?
that you touched here a bulk and then you also split it into monthly. I think many of us, especially in the beginning, at our first purchase, first transaction, had a misunderstanding, or maybe we were afraid. I was like, oh, it's going to be 10,000 more. And then when you get to split this 30 years, a month, it's not that much. It's not that scary, right? But again, if that $30 a month makes a difference, kicks you out of your budget, you probably have to take a step back. Would you say so?
Yeah, we're probably shopping in the wrong price point if that's
Okay.
happening. In that initial conversation, when you're getting pre-approved, you're gonna get a feel for whether it's a good fit, the lender, the programs. And when you have identified the right team for you, then being flexible on location, understanding that you may have to go in a little aggressive on price to win the bid, but you're protected because there's going to be an appraisal too. The bank is just not going to lend money on a property that you're overpaying on. They're going to
That's
check.
right.
They're going to make sure that that value is supported by other sales.
The seller might be overpricing. The buyer might be a little bit rushing with the purchase, but the bank will be probably one of the most emotionless, right? Really cold-hearted.
Correct.
Yeah.
Yes, the bank doesn't have any emotion in it. They're looking at the numbers. So that's the protection. So I think the advice again is work with the right team, understand your numbers, and be flexible. And if you can do those three things, you'll be successful in this market.
That's very good. Because time is of the essence. And when multiple offers are on the same property, if we haven't done our strategies and pre-planning beforehand, you don't know how to act and what to do, right? That's all great advices. Now, if we want to bring some value to few buyers that are just, let's say, they planning 6 months from now to move out of state or buy a new home here, maybe upsize, what would be their 2-3 facts to really focus on?
Well, I always say for anybody that's planning to buy in the next 12 months, now is the time to have a consultation to start building your plan.
Really? Even
Yes.
12 months ahead, now is the time.
Yes, because if that person does need to work on credit, or they do have to save a little more, or they have to research new areas, new neighborhoods, because the numbers aren't going to make sense for what they thought they could get, the more time they have, the better prepared they'll be. And we just want to set everyone up for success because this can be a very emotional process. So we don't want them to be worried about rushing.
That's a good point. All right. I like that. Let's not rush. Make actually rational decision. Consult with a good team and use some time to prepare. 100%. Now, Michelle, where we can find you? If somebody wants to buy a home with you or get a loan with you, where would we find you?
So anyone can contact me on my cell direct. That's usually the best way to reach me, which is 773-858-4102, or find me on social media at
Mortgages with Michelle. Very good. And I do encourage everybody to leave questions in the comments. We will answer to every question in details. We definitely find out you the right answers and the strategies you need. All right. So I'm gonna have just one call to action to everybody. Is if you are in the market, find a good team and don't hesitate, call right now.